Hello guys, welcome again to our YouTube channel Telezales Tabza Tabisoranzi. So as we said that in this video we are going to talk about trading stock deficit. Trading stock deficit as well as what trading stock surplus. So let's find out what is trading stock deficit. Trading stock deficit is when the physical count is less than the physical count. When the physical count, that is what conducted at the end of the financial year, is less than our physical count, meaning we are going to compare the physical count that has been given to us at the end of the accounting period with our physical count. Then the shortage is called a deficit. It is a loss to the business, meaning that we know that trading stock deficit, it is a loss to the business, and all losses to the business are regarded as expenses. And then what are the possible reasons for a deficit in the business? It's errors made during the year, such as incorrect markups, theft of stock, damage or broken stock destroyed, errors in stock taking. So their physical count is it's when it's it's less than our physical count. Then it's a deficit and it's an expense. And then let's take a look at trading stock surplus. It's when the physical count, their physical count, meaning at the end of the financial year. At the end of the financial year, it's more than our physical count. Then the surplus in stock will be regarded as an income. Then it will be as an income. And then we know that whenever we have an income in the business, then we are making money. It's an inflow in the business. And then what are the possible reasons for that? It's errors made during the year, incorrect markups, errors in stock taking, omission of stock purchases in the trading account. So guys, so now since we know that trading stock deficit, it's an expense, and trading stock surplus, it's an income, let's take a look at our wonderful activity. And then we have activity 2. Let's take a look at this activity 2. What are the requirements? Record the following transaction in our general ledger as well as our general journal. Meaning we are going to take a look at our general ledger as well as our general journal. So we have been provided with our wonderful answer sheet, and then we need to just follow our steps. So guys, in year-ended adjustment, always know that we need to have a pre-adjustment trial balance. Then it's our step number 1. And then under pre-adjustment trial balance, we have an account of trading stock with an opening balance of 66,700, while not forgetting our timeline. And then it ends when it says extract from the pre-adjustment trial balance on the 28th February. Then our financial year ends February 2021, meaning it started when the month following, which is March 2020. March, April, May, June, July, August, September, October, November, December, as well as January. And then pre-adjustment trial balance, we have trading stock of how much? 66,700. Then we need to record. And then we have an trading stock. Trading stock, it's it's classified as an asset. All assets will increase under our debit side, while they will decrease under our credit side. And then we are going to record our first step, our opening balance. We are going to say during March 2020, on the 1st, we had a what? An opening balance. It's what? Balance brought down of how much? 66,700. And then that is the only thing that we have in this pre-adjustment trial balance. So now we need to go to our adjustment, and our adjustment, as we know guys, in our adjustment it's our what? Step 2. And then let's go through our adjustment and find out. It says a debtor M Motake. So now we are talking about a debtor again, someone whom we sold goods and services on credit to. It says a debtor M Motake returned stock with a selling price of 98, meaning now that debtor, maybe he's not satisfied with our product, so he decided to return what? Goods and services. And then the markup of these goods, it's how much? It's 100% on cost. The stock count on cost, the stock count at the end of the year is 64,300. No entry have been made. So guys, now we need to what? To record this transaction. So first, this debtor returned goods that are worth 980,000, meaning 980, not 980,000, 980 rand. So this 980 rand, it's our what? Our selling price, meaning it's what? It's sales. It's our selling price. And whenever we do trading stock, whenever we complete trading stock account, we only use cost of sales. That's why they gave us a markup of how much? They gave us a markup of how much? 100% on cost, meaning we need to what? To find what? A cost price. Then we are looking forward for cost of sales, and then we don't have cost of sales. So guys, in what we are going to do in this case, we are going to use the known method or the what? The unknown method. But what we are going to say is that always, what you need to know always, that cost of sale will always be what? Will always be 100%. And then in order to have our and then our selling price will be what? Will be our cost price, which is 100%, plus our markup percentage, which is in this case is how much? 100%. And then our selling price equals to how much? 200%. Meaning right now we know that 980 as our selling price, it's equals to what? To 200%. And then in this case, guys, in markup percentages, they change. Sometimes we'll be given 50%, 30%. If ever you are given 50%, then your selling price is your 100% plus the markup of 50, then equals to 150. If you are given 20%, then 100 plus 20%, then it's 120. But in this case, we are given 100% markup. Then it's 100. It's what? It's our 100%. Plus our 100%, then it's equals to 200%. So now we know our selling price, the 980, it's equals to how much? 200%. And then our cost, it's the what? The unknown, which is how much? Which is 100%. As we said, our cost of sales is 100%. Our cost, it's X, is the unknown, and it's equals to 100%. Then we can use the what? The known or the unknown method. So the known method will say what we have the selling price of 908 multiply by what we are looking for. We are looking for cost of sales, which is equals to what percentage? 100%, divided by what we have. We have the what's the 900, which we have the 900, which is equals to what? 200, and then divided by 200, and then equals to how much? 490. Meaning now our X equals to how much? 490. Our cost of sales equals to how much? 490. So now we need to record this information. This 490, because of it's what? It's regarded as what? It's regarded as what? returns in the business. They are what? Returns. We allowed the debtor to what? To return the goods and services. And whenever the debtor return goods and services, our trading account will increase because of now goods went out but now are coming back to the business. And whenever goods are coming back in the business, our assets will increase. The trading stock account what? Will increase with how much? It will increase with 490 rand, and then we'll record it as what? As cost of sales. And then what is the reference? Is DAJ, is debtors allowance journal. And then we allowed the debtor to return goods and services that they have a cost price of how much? Of 490 rands. And then guys, we continue with our transaction, and then it says what? Our adjustment, it says the stock count at the end of the year, meaning their stock count of at the beginning of the year. We were reading the definitions of trading stock deficit and as well as the trading stock surplus. So their stock count at the end of the year, it's how much? It's 64,300. And then now we need to record that calculate our physical count of stock. So our physical count of stock at the beginning of the year, we had trading stock that is worth 66,700, and then minus 66,700 plus we have the returns of 490, meaning we are having the stock of 66,700 plus the returns of 490, and then plus the returns of how much? 490, and then 64,300 minus how much? 66,700 plus 490 equals to 67,190, meaning their physical count of stock minus our physical count of stock, and then we have a difference of how much? 2,890, meaning their physical stock count is less than our physical stock count. Then this thing, it's what? It's a deficit. It's a deficit. Their physical stock count is less than our physical stock count, meaning our physical stock count is more than theirs. Then it's a deficit, meaning we are losing as a business. What are those possible reasons? Theft, incorrect markups, and other errors in the business. So we are losing in this case. That's why we have trading stock deficit. So let's first close off our trading account. So at the end of the financial year, we conducted a physical stock count, and we said 66,700 at the beginning of the year plus 490. We are looking for the bigger side, and then we have how much? We have 67,190. This is the bigger side, and then what you did on your left must always be made on your right. And then at the end of the year, we were given that the stock count at the end of the year is 64,300, meaning at the end of the year we are closing the books. Then we need to close the books, and then we are going to say at the end of the year we have balance brought down, because they are telling us that we are left with the stock that is costing how much? 64,300. But this 64,300, in order for it to be balance brought down, meaning it started under credit side, as balance carried down, as balance carried down, 64,300, and then this the credit side is not equals to 67,190, meaning now we have a difference of how much? We have a difference of we have a difference of how much? Eraser. We have a difference of 2,890, whereby we said 67,190 minus 64,300, and then that thing is what? It's our stock deficit, and then it's going to go to what? To GJ, general journal. And then guys, as I told you, one account is credited, meaning another account must be what? Debited. Our trading stock account is credited with what? With trading stock deficit. And then as we learned from our information, trading stock deficit is regarded as what? As owner's equity, as an what? As an expense account, and all expenses increase under debit side while decrease under what? Credit side. And then we don't have any opening balance for our trading stock deficit from our pre-adjustment trial balance. Then we'll just continue what? Recording. And then we are going to record one account credited, meaning another account must be debited. So we are debiting our trading stock deficit, saying that we have what? Trading stock that is lost, which is what? GJ. How much is lost? 2,890 when during Feb 2021 on the 28th of February. And then guys, we are balancing the what? The equation. We are closing it, guys, and then the bigger side obviously is our debit side. And then we are going to say the bigger side is what? It's our debit side. And then we are going to say the bigger side is our debit side with how much? 2,890. And then what you did on your left, you do it on your what? On your right. And then even the credit side must also balance. It must say it's 2,890. Then we have what? Because of, as I told you guys, that all the owners' equities, they will be illustrated by what? By profit and loss. And then we are going to write and say the what? Profit or loss, it's how much? 2,890. So guys, and this is how we calculate trading stock deficit. You will always be provided with information that will help you to what? To calculate trading stock deficit or either a surplus. And as you see, trading stock deficit is recorded under credit side, meaning that trading stock surplus will be recorded under what? Debit side, because of its an income. And then guys, so now let's record our general journal. So the first thing that we are going to do under our general journal, we are going to say number one, we start with the what? Account that is debited. Always whenever you do general journal, you start with the account that is debited, and then the last account to be credited, and then the first account to be debited between these two. Which one is that? Is trading stock deficit, meaning we are going to write what? Stock deficit. Stock deficit is what? Debited with how much? 2,890. 2,890. 2,890. And then the last account to be credited, it's double entry principle. The last account to be credited is what? It's trading stock. And then we are writing trading stock. is credited with 2,890, and then we are going to have a narration for this. So we need to provide an explanation. Why are we saying so? Because of we have lost the stock. Is lost the trading stock. That's why we have a deficit. We lost a trading stock. And then guys, let's continue again recording. And then guys, in this case again, what we find in this case again, we find that in this case we find that we have a debtor returning trading stock. This person is a debtor, meaning we need to open our debtors control account. Then there we go, debtors control. Then debtors control. Debtors control is it's an asset. Increases under debit side, decreases under credit side. The more debtors we have, the more the debtors control will increase. And then whenever they pay or whenever they return things back to the business, then it will decrease. So now we have returns that are worth how much? 98. And then one account is credited, and then it's is DAJ. Then we are going to have debtors allowance, since we allowed the debt. And then we have debtors allowance. And then one account is credited while another account must be debited. So we credited our debtors control, then we have to debit our debtors allowance. So and then now we can be able to record under our general journal. And then we are going to say number two, the account that is first debited. We always start with the account that is first debited, and in this case the account that is first debited is debtors allowance. Then the account that is debited is debtors allowance. Debtors allowance is debited with how much? 980, while the account that is credited, it will be our debtors control, 980. And then what is the narration? What is the narration? What is the reason for this? And then the reason for this, it's returns by debtors or a debt. And then guys, because of we sold goods on credit, meaning again we have another account that is going to be we're going to have another account that is going to be affected, which is sales account. Sales account, it's going to be to be affected. And whenever sales account it's affected, then we are losing. We sold goods on on credit. I think this is good. Okay, right. And then let's continue, guys. Then we have sales account. This is sales account. We have sales account. Sales account is owner's equity as an income will increase under credit side and decrease under debit side. And whenever we are selling something, then our sales account will increase. So our sales account has increased with 980. But in this case now, sales are being returned, meaning that we have to decrease our sales. How are we going to decrease our sales? Then our sales will going to be debited with how much? 98. We no longer have 980 for sales. Now we are losing. And then one account is what? It's debited, meaning another account that must be debited. We are losing sales. Why are you losing sales? Because of now the debtor is returning, and then we are going to have to allow the debtor, and then write what? Debtors allowance. It's an expense of the business. And then one account credited, and then all the expenses plus this side minus the side. And then one account credited, meaning another account must be what? Debited. And then now we can be able to what? To write our general record under our general journal. And then we are going to say number 3, account that is first debited, it's sales, debited with how much? 98. And then another account that is credited, it's what? Debtors allowance, how much? 98. And then what is the narration? It's what? Returns by debtors. And then guys, in this is how we complete our year-ended adjustment, the general ledger, and also the what? The general journal. So guys, go home and practice, because practice makes perfect. If ever you don't understand, rewind the video and also comment, subscribe, like, and press the notification button so that whenever I upload, you are notified. So the following video will be all about consumable stores on hand, whereby we are going to understand what is consumable stores on hand and how to record transaction based on what? Consumable stores on hand. So guys, in this thing, it's a bang